Thank you so much for coming, Mr. Rickards. I told that you are the author of 2 New York Times bestseller. The current one made you all over the news and all over the TV, so we are very honored to have you today.
Thank you.
Can we start with your book, with your most recent book, Death of Money? It's a very striking name and title, by the way. What does it talk about? What's the thesis of this book?
The thesis of the book is that the international monetary system is getting close to the point of collapse. And when I say that, it sounds like a very provocative statement, but in fact, the international monetary system actually has collapsed 3 times in the past 100 years. It collapsed in 1914, again in 1939, and again in 1971. When it collapses, it doesn't mean the end of the world. It doesn't mean we all go live in caves and eat canned goods. What it does mean is that the major trading and financial powers get together, they sit around the table, and they rewrite what they call the rules of the game. The rules of the game is sort of the operating system, if you will, for the international monetary system. So what I do is, first of all, explain the instability that's already been created that will lead to a collapse. Secondly, look at what the new system might look like, and then go back to square one and say to investors, here's what you can do today to construct a portfolio that will preserve your wealth in this coming collapse.
You also talk about the central bankers.
Yes.
And their ability, or lack of ability, right? And we're about emerging markets right now. I mean, we talk about U.S. equity markets too. That's my role. But we are talking to the Turkish audience. You are right in front of the emerging markets. Emerging markets have been affected by this central bankers, especially Fed's actions, tapering. And then we saw lots of volatility in the emerging markets. The risk on and risk off.
Correct.
What do you suggest? What do you talk about in your book about this topic? Because emerging markets seem to be the most sensitive to the tapering and to all these Fed's actions.
Well, they're very sensitive, and it's a very good example of how when the Fed manipulates U.S. interest rates, directly or indirectly, they manipulate every market in the world, because the U.S. dollar is the leading reserve currency. 60% of global reserves are in U.S. dollars. So China has $4 trillion of reserves. Most of that's in dollars. Russia, Turkey, although Turkey does have a lot of gold, but other countries around the world have a lot of dollars. So when you kind of play with U.S. interest rates, you affect every market in the world because they're all keyed to dollars. Now, what happened last May, just about a year ago, Ben Bernanke first used the word when he was chairman, the tapering. And what happened is people borrow money in dollars, so in effect they're short the dollars. They go invest in emerging markets like Turkey or Brazil or South Africa, et cetera. Well, to do that, you have to buy the currency goes up, then you buy the stocks and bonds. Well, the minute the Fed says they're going to raise interest rates, everyone wants to get out of that trade. So you sell the currencies, sell the stocks, get back to dollars, pay off your dollar debt, and go to the sidelines. So suddenly, last summer there was enormous turmoil in all these emerging markets. Then in September they didn't taper, the capital came back, now they're tapering, the capital comes out. So I think it's a little disingenuous for the Fed to ignore the impact they're having on these emerging markets. But it's worse than that, because these things can spin out of control. We saw this in 1997 when there was capital flight from Thailand. It led to a global financial collapse. There was blood in the streets in Indonesia and Korea. That's how bad things can get. So I don't think the Fed appreciates how much chaos and damage they can cause.
Globally.
Correct.
Right?
That's right.
Well, thank you. So I also heard you're going to Turkey.
Yes. I'm going to be in Turkey in September as a keynote speaker at the FX Foreign Exchange Conference in Istanbul. Very much looking forward to it. I've been there before. It's one of the most beautiful cities in the world. So very excited to be going back, especially at such a great time of year.
And one of us, Junaid Basharan, will be there too, I think, one of the moderators. And I would like to ask some questions about FX, foreign currencies,
Sure.
right? That's another title of your book, your expertise. Talking about China, you just mentioned China. China is confronting the U.S. and East Asia.
Yes.
Russia is confronting the U.S. in the East Europe, and Saudi Arabia is upset with all this deal, what's going on with Iran at U.S.
Right.
What are the implications of these separate developments for the future of the U.S. dollar as the leading reserve currency?
Right. The implications are very large. Think of the dollar as sort of resting on a platform or a stool, and the stool has 3 legs: Russia, China, and Saudi Arabia. Now, as you mentioned, Russia and the United States are engaged in financial warfare around Crimea. Russia invaded Crimea, took it over, is causing trouble in eastern Ukraine. The United States is not going to respond militarily. No one thinks that's a good idea. but we are engaged in economic sanctions, which is a kind of financial warfare. So that's going back and forth. If that were to escalate, it could get very bad. Russia could actually unleash their hackers and close the New York Stock Exchange. I'm not saying that's going to happen, but that's the kind of potential. And Russia is trying everything they can to get out of dollars. They're starting their own payment system. They're acquiring gold, et cetera. Over to China. China is buying thousands of tons of gold. Now, China has $4 trillion of reserves, mostly in U.S. dollars, which we mentioned, paper assets. They can't dump them. They might like to, but the market's not that big. But what they're doing is they're building up gold as a kind of hedge, so that if the U.S. inflates the dollar and they lose value on their dollar holdings, they'll make it up on the gold. So they're building a hedge position. Saudi Arabia feels stabbed in the back by U.S. détente with Iran. The U.S. has, in effect, green-lighted Iranian nuclear ambitions. This goes back to the 70s when Saudis agreed to price oil in dollars in exchange for guarantees of their national security, the continuation of the House of Assad. Now, the U.S. just pulled the rug out from under their security guarantees, so they may pull the rug out from under the dollar. So you look around the world, these things don't happen overnight. I'm not saying they'll happen immediately, but three major supports for the dollar are all moving away. So this could lead to a collapse of confidence in the dollar.
Oh my goodness, it's very well put. And I wanted to ask you two more questions about this, but my producer is telling me our time is up. We have to have you again. That's what it means. Thank you so much for coming.